Would you like a roll call?
Go louder. Start a local recording too. Yep.
All right, Adam Brandon,
Here.
David Brewer,
Present.
Al Torrens,
Present.
and Daniel Dorn.
Present.
All right, 4 trustees present, you do have a quorum.
Good deal. I'm looking for the minutes in the package, I think.
I didn't ever get onto her. I'm
gonna make sure that's on
today. We'll approve them.
Okay, we'll table that till next time.
He's telling
First up is Actuarial Concepts to talk to us about the actuarial report, and in the package is the draft of that along with the relevant portions of a very long document. So, Mr. Kearney, can you hear us? Mike? Hello? Okay.
Let's say he was on there.
Okay. The floor is yours, sir. I said you have the floor to kind of go over the report with us.
Hey, Mike.
I have. Okay. Investment advisor person,
I'm sorry.
Brad Standing.
Hi, and I'm sorry, I'm not sure if you go by Michael or Mike, but this is Brad Hess from Anco Consulting, the investment consultant for the plan. It's nice to see you. So reasonable is in the eye of the beholder, right? So one, when you make this declaration that he's talking about, this is a state law that says every year you have to state what is a reasonable return for the next year, the next several years, and the long term thereafter. That's the verbiage you have to, and we submit that to the state. And this, basically you want whatever's in your report to match that declaration. Now that doesn't mean that you can't go after you make that declaration and go lower your return for the next year, if you wanted to do that, right? But if you make a declaration of, we think it should be 6.5 for the next year to the next, and your report that you're issuing to the state doesn't have that, then it's like, why is that the case? So that you want whatever's in the report. So my question is, Mike, did you run the report with 7.25 or 7.0? Yeah. And I think personally, right, stock market came down 18% last year, bond market came down 13%, so we had a resetting. That is medicine that we had to take for that fiscal year. But the expectation in the future, particularly for the bond market, right, has gone up significantly relative to where it has been. So I think it's reasonable to stay at 7.25, particularly in light of a year in which, you know, and I'm not sure what the city contribution is and there's smoothing effects and that kind of thing, but we had a bad year. You don't want to lower, you know, in a bad year. You want to lower, like we did the year before when we were up 20%. That's when you kind of want to take that chance to lower, right? So we're seeing a lot of cities right now, even if they're still planning to go lower, take a pause this year, and I certainly think that's reasonable.
I do have a question. On page 1.5, it says 7.75. Is it 7.75 or 7.25?
That's a question for Mike, but I thought it was 7.25 we were at.
Alright. So that's a typo on that page on 1.5? I said, so that's a typo?
Yeah, I don't have the report, so. I know a few years ago we were at 7.75.
I thought we were still at 7.75.
Yeah. So Mike, can you go to page 1-5 of your report? And right under the chart, there's a double asterisk about the APV of accumulated plan benefits. Yeah, but this is stating that the statute required the assumed rate of return, future return of 7.75, but last year we lowered it to 7.25 and the board approved that. So is this just a typo?
This is in addition to.
Okay. Okay, that's what I was trying to understand. Thank you.
I mean, longer term, it's probably prudent to go down to 7, just to get closer to FRS, just in case one day they impose their mortality table on you guys, right? And they said you have to use that by law. Now, it's highly unlikely that they're going to come and say, you have to use FRS's return assumption, but it's not out, there's maybe a small probability that happens. And if you have to go from 7.25 to 6.7 in 1 year, that's a big jump that would cost the city money. So in my opinion, 7.25 for this one's fine. in the back of our heads, we should consider every year, reconsider this and potentially, if we get a better year next year, we can go to 7.0, but I think you're fine doing 7.25. Yeah, you want to try to be as ready as you can be, but we don't know what's going to happen over the next 50 years, right? So the reality is we'll just adjust over time. But the benefit doesn't change, right? Your benefits are locked into based upon what is guaranteed. So it's really, it gets to the timing of when it gets paid, right?
It just affects the glide path of the contribution. It's
Right.
not- You can be high, you can be low, but
Right.
eventually you have to zoom in and.
Yeah, and then like the last check for the last member, whenever that is, that's kind of, we got to true it up, right? Yeah.
Just adjust your glide path as you go.
Yeah.
Okay, I know.
So there's two things here. So one, you have to approve the valuation that Mike has presented to you. And then the second thing is to do this declaration that, I used to send an email, but now that you have a plan administrator, I'm going to delegate the responsibility to your plan administrator. So that would be the first thing. It would be a motion to accept the valuation as presented by your actuary.
Right, I think I'm fine with the proposal, and I'm also fine with going kind of slow on the interest rate reduction. Anybody else have any comment about that? Al? What's the worst that happens to us? The state doesn't like it, they make us redo it? Is that the end?
Yeah, and you're not, I have plans that are at 7.6 still. So at 7.25, I'm gonna say the average that we see, and we have, not just Mike, we have other actuaries, is probably 7 is the average, what we see. So you're a little bit above average, but I mean, you're within what we would consider reasonable relative to other pension funds.
And I
When you were at 7.75, right, which is just a couple years ago, that was really high relative to other plans.
And I think also the fact that we're well-funded by their definition,
Without question.
if they're gonna go up.
Yeah.
Okay, I'm fine with that. So we make a motion I hear a motion to accept the report. And
Yeah, I'll make a motion to accept it. I'll second.
Daniel, okay.
okay, all in favor, say aye.
Aye.
Anyone opposed? That motion passes. I think we. Sure.
Sure, always.
Uh-oh.
I think, Dan, you were saying that maybe it was last meeting about the county kind of taking some of the property and classifying it outside of the city and into the county. Has that been going on? Do I remember you talking about that? No?
I do know that, the city, inside the city limits, has not had that much development, but this is based as a percentage of fire insurance premiums. And I can only testify for myself, but my homeowner's premium sure have went up, so one would think it would go up for nothing else, just based on that.
Mike, what's the process in your opinion for the board to audit that, if that's even possible? Because it's like, it seems like it's like this black magic about how the state comes up with these numbers. No one really knows.
Borrow the money from the insurance.
Yeah, like, and how that calculation occurs. It's real, like, real, there's not a whole lot of transparency on that.
I can tell you back then, that's a good. Go for it.
Thank you.
Thank you, Brad.
So-
Thank you.
Well, that was us, but I appreciate that. One thing that I do want to mention, you do need to make a motion to, and I'll just say, it's based on your investment consultant's recommendation that 7.25 is a reasonable return for the next year, the next several years, and the long term thereafter. You can just say so moved, whoever.
Okay. Okay, that's fine. So do we hear a motion to approve the 7.25 interest rate?
I'll make a motion.
And your second,
I'll second.
any more discussion? All in favor say aye. Aye. Anyone opposed?
And just to confirm, Michelle, you will file that, right?
Yes, we will. It will be filed.
That's mine.
Mike? Mike, I really appreciate it. Thank you very much, sir. You're welcome. Will do.
Awesome. Thank you.
Okay, next on the agenda, Peter Bauer.
Well, good morning, everybody. Well, we had a good quarter. It was still kind of a value period. Remember, we're talking about the last quarter of last year, 2022. And value was really the place to be all last year. Growth is the one that got clobbered. I will say that since the first of the year, that's somewhat reversed. Value is still doing okay, but it looks like growth is taking the lead. For how long, I don't know, but we've had a lot of improvement on the growth side of the style for investing. So we did have a good period, but before we get into the report, let me just give you a little bit of a kind of a overlook as to what we're seeing. First of all, as you know, a lot of last year, people were anticipating, Wall Street strategists been anticipating a recession. Well, we never got a recession last year. Then they said it would be this year. Well, there is no recession in sight. I'm not saying we won't have one, but so far the evidence is showing up that we may very well skirt one. They're talking about a soft landing, but for a soft landing to occur, you have to have a downtrend. We don't even have that. We've got great employment numbers, got great consumer participation. Retail sales have been terrific. You know, there's new stimulus in the economy in the form of the infrastructure bill starting to hit. You've got the Inflation Reduction Act, which throws more money into the system. Our government happens to be running a deficit of about $1.5 trillion a year. That's stimulative to the market. So I'd be surprised if we have a recession. But the market is kind of sniffing that out too, and I think that's one reason growth companies are starting to come back. Some of the leading sectors in the stock market right now, one of them is industrials. Industrials don't lead when you're going into a recession. These are very business cycle sensitive companies. Financials are doing well. Financials tend to anticipate bad loans, and when you're going into a recession, financials usually do not do very well. So there's a lot of signs that the market's okay and the economy is okay. Now, we had a terrific start to the year. And if you annualize that, you'd be over 100% return for the year. That isn't gonna happen. So we're probably gonna have a lot of volatility and a lot of sideways action. January was terrific, but you can't annualize it. And a lot of ups and downs this year, so I think everybody just has to anticipate that. We go back and forth on style. One day, growth is doing real well, the next day, value is doing real well, or week to week it changes rather rapidly. But at any rate, we have balanced the portfolio a little bit more. We're still very growth oriented, we're growth people. We love companies that, by virtue of what they do, grow their revenues, grow their profits, and become more valuable over time. That's what we believe in. We believe that that's how you make money and how you create value for owners. But we're a little more balanced. With that, let's get into the report. If you'll turn over the first page. This report's a little bit different. We went through a system conversion, software conversion last year. We ran 2 software systems in parallel, and we're now on the new system. There's a few little bugs, irritations. This is a very well-known company that we've got this system for. It's called Black Diamond. It's all cloud-based. We have to go cloud-based because we have to be able to show the SEC that we have a continuity plan, which means there's a hurricane, the building shut down, or there's a fire, whatever, we can continue to operate. Well, being cloud-based, you can operate from anywhere, as long as you can get on the internet. And so that's why we've done it. Everything we're doing now is all cloud-based. So we can operate remotely, communicate with each other, everything else. So that was the basic driver of the software conversion. But it's a good system. It's a very good system. At any rate, if you look up at the top, we have about, at the end of this period, 5.352 million. Everybody see that? Have quite a bit of cash at this point. We've since applied that cash. And it was good that we had some cash because right at the end of the quarter, we got a email saying that they needed about $53,000. And that was, of course, sent out. We do keep some cash around because we get these periodically. We've been surprised a few times and trying not to have to make last-minute adjustments to everything. We're keeping a little bit more cash than we usually do, but not this much. It's way down from here. If you look down at the bottom of the page under activity summary, you're going to see that we started at 4.958 million. The 53,000 went out. About $2,200 in expenses. Those are trading expenses. Because of your custodian, we don't get free trading. There's a DVP trade charge for each trade.
That's Fifth Third?
Yeah. Then we've got we actually do the trading through Schwab, but then it gets DVP'd to Fifth Third, and they charge us, I think it's $25 a trade. It is what it is. We try to keep it down, but it is what it is.
Is it $25 a trade?
Yeah. And on an overall basis, it's pretty much nickels and dimes just in terms of the amount of dollars here, but that is a cost. You had about $20,000 worth of income, so that shows you where we ended up at 5.3 million. If you look at the chart over there, you can see the chart, there's a trend line there. At the bottom is the place for the dates. We'll get that squared away a little bit. There's a lot of dates, more dates down there than need to be, and it just looks confusing. It looks like jumble, but we'll get that squared away. That's part of the new software system. This is a custom report. If you turn over to the next page, we'll go right to the bottom. Quarter to date and year to date are the same thing. The stocks actually were up 9.8%, but since we had cash, it was around 9%. I see that ANCO has us at 9.19. But at any rate, we're 9% plus. The benchmark was around 7.6%. NASDAQ over that period, and this shows you what was happening in growth, was down 1%. NASDAQ was still under a lot of pressure, which is where most of the growth stocks are. And then the Russell 1000 growth, that was up 2.1% in that period. So balancing the portfolio made a big difference for us during that time frame. The market has been good in January, and we've added to those gains. If you turn over to the next page, we can just highlight a few things. These are the actual holdings and the cost basis. As you can see, we do have some energy stocks. We have Exxon, we've got ONEOK. Freeport-McMoRan is really a materials, I'm sorry about that, that'll get reclassified and goes down with Dow Chemical. But we have two holdings there. We have since added Baker Hughes, which is a an oil service company. It was put together by General Electric, contributing their assets plus Baker. On the industrials, we're fairly well weighted on industrials, and this has been a very good sector for us. You may not know all these names, but you know John Deere, you know Emerson, you know Honeywell, you know United Parcel Service. These really haven't changed. On the discretionary, Amazon's gotten a little bit controversial, but we think it'll be all right. Lowe's is doing quite well, coming back nicely. Netflix was a recent purchase, and we got it at a good price, and it's doing very well. Target did not have a good year, but it seems to be coming back nicely, and Ulta's been terrific. Ulta Beauty is just continues to be a terrific growth company, adding locations and having a lot of same-store sales increases, and they have a great online presence. In Staples, Helen of Troy has been sold, just didn't perform as we'd hoped. PepsiCo, you know that one, that's over on the next page. Healthcare is really a mixed bag. The healthcare area that was the old pharma companies, the old pharmaceuticals that had very little growth and a lot of good dividends, they did very well last year just because they were considered safe. And the growth areas in healthcare were pummeled. Now that seems to be reversing. The old pharma companies are still doing okay, but what's coming back are the more growth ones. And that would be a company like Edwards Life Sciences. They make valves for your heart or for your aorta that can actually be put into place by weeding it through your veins and putting a new valve in, where they used to have to cut you wide open and crack your chest and put a valve in. You've probably heard of elderly people sometimes have to have a new aortic valve put in. They've come up with some wonderful technology, great growth company. Illumina is a lot of DNA testing, and more so medicine relies on your specific makeup cancer drugs work with certain people and they don't work well with other people, and the way they know that is to do DNA testing. But it's becoming ubiquitous to do that. Intuitive Surgical is robotic surgical, is robotic surgery. That's getting bigger and bigger. Pfizer is somewhat controversial to us. We're leaving it there for the time being, but that may be changed. They do have 19 new compounds in the pipeline that they think will be coming, to late stage testing over the next couple of years. So there's a lot of promise. The guy who's running it is done a masterful job of moving an old stodgy company that really didn't have much R&D into one that's really got a tremendous pipeline. We're watching it closely, but so far we've stuck with it. In financials, as you can imagine, as interest rates go up, the banks charge you interest rates, higher interest rates, long before they give you higher interest rates on your deposit.
Really, David?
There's you've probably seen that, that's
a phenomenon.
it's a phenomenon. At any rate, this is very good for the banks in terms of their earnings and their net interest margins is what they call it. We have a number of other companies here. Goldman Sachs has gotten a little bit controversial. They made a mistake a couple of years ago trying to get into kind of retail banking with something they call Marcus. They're backing off from that. They're going back to their knitting. Goldman Sachs' strength has always been as an investment bank, a trading bank, a M&A, mergers and acquisitions, new issuance, raising money. They are second to none in that business. At any rate, they're cleaning themselves up, but we think we're gonna stick with it. JP Morgan is a quality company. MSCI does a lot of indices, and they have a huge stable of revenues that are consistent. Regions is a local, and Charles Schwab, we actually sold Charles Schwab. The reason we sold Charles Schwab is as interest rates have gone up, people started pulling balances out of their accounts because they could go buy a 2-year treasury at 4% or a CD at their credit union or something. And Charles Schwab's business model is to make money on these balances. So they don't charge you a fee for trading stocks, but they're counting on you having money and extra money in your account on which they make money. There's a few other ways they make money, margin interest, whatever. But that was a very big part of their business model. And the presumption was as interest rates went up, they would be able to take that money and make more money. But what's happened is people are pulling it out and disintermediating, taking the money away from them and putting it into treasuries or CDs or something on their own. So their business model is kind of working against them right now. So we decided we'd just go ahead and find something else, which we have. In information technology, well, Cisco just reported last night, had very good earnings and raised its outlook. Cognex is machine vision. Every robot is going to have probably some Cognex in it. Intuit, you know them by QuickBooks and TurboTax. Keysight does a lot of testing equipment. Marvell is a specialized chip manufacturer that has some wonderful niches in 5G, cloud computing. Microsoft is actually turned around and done very well. It was interesting, right at the bottom, an analyst put a sell on it, and he hasn't seen that price since. It's much higher. Qualcomm has come around, and so has Tyler. Your city right here uses some of Tyler's software to manage their internal processes. Alphabet, which is Google, and Disney. Disney is coming around because Bob Iger was brought back in, is taking a real hard look at expenses, and we think it's a premier company. It's got assets second to none. I mean, there's just so many ways to monetize, make money off of all of the assets they have. So we think that's a good core holding for a long time. Anyways, that's your portfolio. And except for a few changes, we think we should be pretty good this year.
Thank you. Quick question.
Mhm.
9%, that's better than S&P 500, that's good. On page, it's the first page where you have the, page 4 of 10, it says cost basis. Is that a mistake? Is that a reporting error?
Where's that?
It is. Page 4 of 10 at the top, it says cost basis $27.4 million. I think it's something.
Oh, yeah, that's a mistake. I'm sorry. I don't know how that got in there.
Just, in case you didn't mention it, make sure y'all fix it.
No, yeah, I apologize. Again, there is a little bit cleanup yet to be done on this system, and I do apologize. This is the first period where we've used this report exclusively, and there's just some cleanup to do.
Yeah, you're not as bad as ViStar Bank, or have people standing outside on Sundays.
Yeah, it's been, you know, they tell you that the transition, is going to be easy, it will be seamless.
Well, they're selling the software.
Yeah, well, we've done it once before. It never is. It takes a while to clean it up, but they've been pretty good. They've been good to work with. They're doing a good job.
So Peter, what's your outlook for the rest of the year?
I think it's gonna be a good year.
So you're thinking, we're not, Bloomberg this morning, I was listening, they were saying, we're not gonna have I think we may avoid a soft landing, but not having a landing at all. Just kind of,
Yeah, no recession,
no recession.
no recession. It's looking more and more like that. I mean, you know, something could come out of the blue, something, you know, the war in Ukraine could spread, or something come out of the blue, or China invades Taiwan. I mean, you know, there's always those left field kind of events that can just derail things. But if everything is reasonably stable, our economy is doing fine. Retail sales were surprisingly strong the other day. Inflation is still coming down, but more slowly. And our take is that inflation is going to be sticky. We think getting to 2% is going to be very, very hard. So we think long-term bonds are overpriced right now. Long-term bonds, the rates are going to have to go up. Long-term bonds have been under short-term bonds, anticipating that the Fed is going to pivot.
Right, yeah.
And that we're gonna go into a slowdown, and therefore 3.5% on a 10-year, or it's 3.8 right now on a 10-year, is a good rate. Well, if our assumption is, and our belief is, that 3-4% is gonna be tough to get down below. When I was going through school in economics, 3% was considered to be a very good inflation rate. It was considered to be a good target. Then Greenspan came along and he lowered it to 2%. And a couple times he scared himself because we almost went into deflation. And under deflation, so much of our banking system collateral doesn't work. And it's very tough to get you out of a deflationary spiral. We know how to handle inflation. We don't know how to handle deflation. So you know, they may have to change their outlook at some point. They're never gonna say it, but we think it's gonna be tough to get below that 4-3% kind of a range. And it's already starting to prove to be a little bit sticky.
Yeah, I mean.
So long-term bonds,
10 years at 382, I think, yesterday.
Yeah.
And
it's a little bit under it this morning when I
6
saw
months,
it.
1 year's over 5.
Oh, yeah, so it's very inverted. But we think that's gonna have to normalize somewhat, because you should be getting whatever the long-term inflation rate works out to be.
Plus a percent or so.
Yeah, we should get some premium to that, some real returns.
But we hadn't had real returns in
A long
I'd have
time.
to go back and look it up, it's been so long.
But, you know, everybody is so fearful of these interest rates. I can tell you, these are pretty good rates, but we are just getting used to it. Get used to it. These are good rates. I remember 8-9% was kind of, we spent a decade with those kind of rates in the 90s, you know.
So we think rates are gonna be here, if you're an investor, you flatter on the short end and get the higher return, and then with the expectation that when that matures, it's still gonna be there, or the curve is.
That's exactly what we're doing for our bond portfolios. We're staying short. There'll be a time that we may want to push out a little bit further. We just do not think it's not worth the risk, and we're not being paid for it. So, 1, 2 years is about as far out as we're going, 3 in a push. But we're getting very good rates there. Still wouldn't meet your actuarial assumption, you're 7.25, so you've got to get a return somewhere else.
The market, between the two of them, it's almost a perfect storm from trying to, actuarial return.
Oh, yeah. Over time, we've done a terrific job. I mean, you've met your actuarial return, your plan has always been sound, and it'll stay sound.
The city's contribution, I noticed, is not that much money this year, so that's a good.
Well, they smooth out returns anyways, and that's really the right way
It's
to
less
do
than
it.
it has been, it's like $100-something thousand.
Yeah.
That's not
Well,
bad.
that's peanuts.
We need to bump that up.
See, well, when we lower the rate next year,
Huh? The city we need to get them to start putting it more so that they get used to it.
right, as soon as we talk about that interest rate, when we go from 7.25 to 7,
Yeah.
it will pump up their contribution.
Yeah, it always does, but I'm a little bit surprised. I mean, it seems like there's always a reaction, it's like closing the barn door after the cows have all left.
Oh, yeah.
They're pushing down the assumption rates. You look at a long-term history of the stock market, and I mean through world wars, through crises of every imagination, you're talking 8, 9 to 10%, depending on what category you're looking at.
Trying to think
You
about
smooth it out. I mean, look at one of those long-term charts. That's the trend line, and it looks like that's really not changing. I mean, there's no reason to believe that there's some sort of secular change that's gonna change that.
Much during that, I think, Peter's past 3 or 4 years prior to the pandemic, interest rates were so low, you could make the money in the stock market, but the bond market, was.
Well, that's why we went to 70-30.
Yeah, you're making basically nothing, so do the math, you can't get there from here.
Yeah, so it was a drag on everything else you did. Well, it's still a drag, it's just not as much of a drag. But if you're getting 4 to 5% now, it's much less of a drag.
Yeah, at least it's
Virtually much
not a
less.
round up figure.
No, so,
Okay, anybody else have any conversation? Yeah,
well, thank you very much.
thank you, Peter.
Before Brad goes, I was wondering, we have
Brad's
stuff,
next up, so.
we have stuff that we need to vote on. Can we, are you in a hurry, Brad? I was wondering if we can jumble you around.
You gotta go.
I need to leave at 10:30.
If you wanna pay the bills first.
Let's look here, we got the.
Well, I know we got some bills we need to pay.
That's the consent agenda.
False release of consent.
Consent agenda, what that means is unless you object to.
There's several here. I just put
Anybody
them
object?
Thank
All right.
We gotta pay the bills.
Yeah, we gotta pay it. We got a little bit of transition, so that's okay.
I
I do
also,
wanna talk about,
They need the access to Fifth Third too.
And actually, you're pretty good at, if you wanna go, because we got 4 trustees.
I'll leave.
All he needs is 3.
what I was gonna say is, you guys, buddies here, the first federal checking account, we need to get that hold of, apparently, we paid it. You guys, one travel voucher, you need to make sure they get the receipt on that.
Yeah, I've got to bring it, I won't scan it all.
Yeah, because we need a receipt on that, and then y'all need to either close that account or whatever.
So we can't close it because we're not on it.
Okay, I can, so.
Whoever's name is on it needs to close it. I'll be happy to help you, kind of walk you
Just
through
send me
it.
an email telling me who I need to have the cashier's check written to close it.
Absolutely, yeah. It would be to the plan, and then I'll send it over to Fifth Third, get that deposited.
does that
Or-
require
or
a motion for the board?
I think so, yeah.
Yeah, I
Or
think
if I ask Fifth Third for wire instructions, I have that accomplished.
Yeah, we
Oh,
have
okay,
fire
great, yeah.
instructions, because we just did the real estate one, but y'all should vote on closing that account as a board.
Right.
Anybody have any objections to closing that account? We don't need it. So.
Yeah, it'll be a lot easier going forward.
Okay, all in favor of closing the account, say aye. Consensus. And the other thing, Brad, I'll mention to you is there's about 100 and something thousand bucks there, so.
Yeah, so that's the problem, like sometimes we get these, you know, the distributions and then the last quarter, right, I mean, it was like, was it Christmas Eve?
Yeah, we're scrambling,
Yeah, and you were on vacation, I'm calling, you know, Adam, what is, you know,
That'd be easier, that's fine.
making, wrapping his presents and stuff, so, that, the way, everything is just at Fifth Third and then we can just, it's much easier.
Okay.
So one thing that I'll mention is, I know you have, I have been asked to present a fee increase basically to you all. And it's a letter here that I wrote with the proposal, so to remind you all, we get paid a flat retainer fee, we don't get paid a percentage of assets under management. You know, we're your independent advisor, we're fiduciary to the plan. And the last time that we had an adjustment to our fees was January 1st, 2017. So we've been making the same amount of money since, for the last 6+ years now. So you can see at the bottom what we're asking. We're at 17.5 right now. We're asking for basically a raise to 22.5. It's about the same from an assets under, we don't charge assets under management, but it's about the same. And we wrote some of the highlights of some of the things that we changed since the last time we entered an agreement, right? We added the real estate, we upgraded our value component, fired Anchor and hired 2 new managers, and I'll get to it, they performed well last quarter. And then obviously longer term, we're meeting our return assumption, so.
I wasn't aware it had been fixed for that long, I thought it was some kind of COLA attached to it.
So we don't, and you know, we can do that if you wanted to, so if you wanted to approve this and then just add a COLA, then we can just set it and forget it. Every plan kind of does a different policy towards that. But we don't have a COLA, so we've been making the same amount for the last 6 years, so we are asking.
That's probably not fair. We can go ahead, I'm okay with this, but one thing, you gotta give us a, new retainer agreement, or is this just gonna be it?
No, so basically, if you approve this, we would say effective March 1st, this would go into effect. I would reach out and I said, Bonnie, just an update, just a 1-pager that would be an addendum to our current agreement that she would review and sign off on, and then if she says, gives you the okay, then you can sign it.
Okay. Anybody have any concern or discussion? Mayor, motion to approve this proposal.
I'll make a motion to approve it.
I'll second. All in favor, say aye. Aye. Any opposed?
Thank you so much, I appreciate it.
Brad, you wanna do the your next on the agenda anyway,
Yeah.
talk about investment results and anything else you'll talk about.
Yeah, so I'm not gonna go through this, you can read this. Page 1, Mike Welker, our CEO, writes a letter to our clients. I will take this opportunity to officially thank you for your business. Thank you for the vote of confidence to approve the fee increase, but we were working with this plan. And I'm not sure if Al and David have been around since 2000, but 2005 is when you entered into our first agreement. So it's been 17 years, over 17 years now that we've been working together. So we certainly appreciate it. It's not,
I think I was here.
Yeah.
it's rare today's day and age to have that long of a relationship. So we certainly don't take it for granted, and we're going to continue to work real hard for you. But I won't go through that. Anco, we're doing great. Last year was obviously tough for financial markets, but we continue to invest throughout our firm, adding people across the research, consulting, performance reporting, compliance, adding analytics to help monitor the portfolios, et cetera. I think Peter did a good job of explaining what's going on in the markets. I will, he didn't talk a whole lot on page 5 about fixed income, but after 3 quarters of misery, I'm actually able to present some good results for you. So glad to that. He talked about S&P 500 up 7.6. The green is bonds. We finally got a positive return of about 2% in our bonds last quarter. But on the bottom right-hand side of page 5, you can see the 1-year period, that's negative 13%. So we have data for this index, the aggregate bond index, since '76. And then we found another kind of bond proxy that goes back to 1926. And last year was all by itself as the only year that bonds declined more than 10% since 1926. that gives you a sense for, you know, how low rates were and the reaction to how aggressive the Fed was in raising rates. That being said, you know, going forward, we can make a better return right now. You know, our bond fund, which is more conservative, we did that purposefully, right? We don't have long bonds in our portfolio. We're an intermediate bond. That's still, because of basically the shorter end of the curve is so higher, that's yielding over about 4.5% right now, and that's you have to go back over a decade to get to a time where it's yielding that. So in terms of the math of getting to that 7.25, it's, even though we took this step back last year, it's actually improved because you have to go back to 2007 to get to a time period where interest rates are at a level that they are now, and that increases our likelihood that we'll actually get some return out of our bonds, which is a good thing. Going to the plan results. Flip to page 16 and 17. This just shows you 9/30 versus 12/31. So we had 10.1 million at the beginning of the quarter, and we're up to 10.65 at the end of the quarter. You can see the asset allocation is pretty similar, 71% in equities, about 15% in fixed income, 12% in real estate. You can see the real estate came down a bit, after being just, performing amazingly. Commercial real estate is starting to show a little bit of softening, so we had some negative returns for the quarter for commercial real estate. And I think the next couple quarters, that market's kind of frozen right now. You have a lot of plans that had, you just incepted, I think, back in April, that fund. And it's actually, it's positive since inception, but last quarter was negative. And we're seeing a lot of plans be considerably overweight real estate right now relative to their policy, which is causing them to kind of ask for more money back, because everything else was down last year, and real estate up until the last quarter was up almost 15 to 20% for the first 3 quarters of 2022. That, and with interest rates going up, we're seeing a bit of a kind of a freeze in that market. The transaction volumes have come down, so you're seeing a little bit of a reevaluation there. And I continue to think that, while Mike gave you guys kudos and gave, I guess, indirectly me kudos for introducing it, the next couple quarters are going to be soft there. We anticipate that returns are going to be slightly negative. We don't see kind of a 2008, 2009 type of period where things go down 20+%, but it'll be a little bit weak. At the end of the day, we're in this for the next 50 years. We still think it's going to be a good diversifier, a good source of income, and a good source of return generation for the total fund for the long term. But we're just going to have to, just like anything else, like our equities are down 18% here.
Are those funds like not available right now? Is that what you're saying?
Yeah.
Real estate, if you wanted money out of there, they just tell you you have to wait.
So they're giving you a little bit. So ARA, right, if you said, give us $100,000 back, last quarter they gave you 5% of that. They gave you $5,000, and then they carry over $95,000 to the next quarter. So they're giving out drips and drabs, but largely speaking, they basically put up what is called a redemption queue, which allows them to protect the fund. They don't have to go out and sell a warehouse to fund redemptions. They have that flexibility, and I anticipate right now that that's going to last for probably at least during the next 4 quarters.
Okay, all right, but it's not really available to us then.
I mean, to a certain extent, we right now we can't get money out if we wanted to. Yeah, we could, like I said, they're probably going to pay out 5% or so of any money that you request each quarter, and then if interest rates stabilize, right, in a quarter or two, then I think that market will thaw a bit, where you might see bigger distributions. But my assumption right now is that if you put money in and wanted to take money out right now, you're not going to get it for 4 to 6 quarters.
If you wanted to sell that interest, is there a market for it, or you just kind of stuck that somebody wants to take it?
The market is you sell it back to the fund. So this is you're a limited partner in a partnership, And every quarter they do a valuation. And so you get, basically, they strike an NAV on a quarterly basis. So a mutual fund, right, you get an NAV every day. These funds, they strike it on a quarterly basis. In normal markets, you get the ability to do quarterly liquidity. So we could, they would usually pay out their entire distribution queue a quarter if you say 18 months ago when the market was robust. But right now, given the market's frozen, they have the ability to limit that. So we're kind of frozen right now for that investment, yeah. And that works both ways. They're not taking money either, which shows you which is an interesting dynamic. They're saying, we don't want to make money in our, for that management fee because of the dynamics of the market, which again, I think, shows that they're not, what they're doing in restricting money, they're not like kind of trying to say, oh, we're not going to give you money, but we'll take your money. It's everything they're kind of putting on hold right now, which I think is really in the best interest of current fund holders, so that they're not forced sellers right now. Any other questions about that now? Page 17 just shows you each of the funds. I'll just point out, obviously, we're kind of, River Place is they talked about being the piggy bank and the cash needs, and the reason for that is that they hold 50% of the pension right now. So that's obviously a pretty large part of the overall asset allocation. Page 18 is your investment policy statement compliance. So this is our asset allocation, current allocation versus our targets. So you see we're technically outside of policy for total fixed income, but we also have cash, and I always add the cash to the fixed income to come up with where our target is. So if you add the 2.5%, and that's in R&D, that's how much money we have in cash, including that first federal account that we have, and add it to our total fixed income, that gets us to 17% versus a 20% target, which puts us in line with our policy index. So, basically, we're right on top of everything. We're a little bit overweight equity, and a little bit, this is as of 12/31, a little bit underweight real estate. I think if you did a snapshot right now, both our fixed income and our equity would be a little bit higher, that triangle, and then the real estate would be probably closer to its target, given the weakness in that market.
It shows Anchor still in here. Are we still a little bit with Anchor, or is that just, did it expire at year's end?
So
It shows 109,000 market value of Anchor.
yeah, so I'll have to look into that. Basically, I'll make a recommendation that that might be just residual kind of dividends that hit after the fact. Now, one thing that
I just didn't know if we.
no, we're completely out of Anchor. Now, we turned that account, instead of opening a new account, we just said, hey, let's put the new mutual funds into the old Anchor account. So we had Anchor basically liquidate their portfolio, and then we put the mutual funds into that account.
What is his third?
Yeah, exactly. So instead of opening a new account, we just said, let's just recycle it. So there might be some just kind of weird little nuances to that.
Accrued interest coming in or something.
Yeah, exactly, or dividend
When the next
payable.
report, they will figure that out.
But I have no recommendations for a rebalance. If you want to go to page 21, we can go through the cash flows. So you can see $10.1 million total fund financial reconciliation at October 1st. Behind the scenes, in between quarters, we had to raise some cash to pay distributions. So you can see we raised some money from River Place. We raised some money from Dodge & Cox and Vanguard Equity Income, your new value funds, and also from Integrity. We had contributions in the door of $42,734, distributions of about $170,000 in the period, paid management fees of about $4,500, other expenses of $7,290. We had dividends and income of 165,763, and capital appreciation of 507,627. So that got us to $10.65 million.
Going in the right direction.
Yes, and you can see that it was a great start to our fiscal year, page 22. Net of fees, we're up 6.6. Our policy index 5.1, so we had some nice performance, particularly in our equities. Peter and his group outperformed. Both of our new funds outperformed their value index. You can see on page 23, those new value funds up. Dodge and Cox was up 13% in the period. The Vanguard Equity Income up 14%. It was a quarter where value did better than growth. And then, the River Place has a little bit more of a growth bias, so a little bit under. But for the quarter, everything was kind of hitting. I actually looked at the Anchors numbers, the one that we got rid of. They were up 11% for the quarter, so they underperformed their index and did worse than the two new funds. So, granted, this is a long-term deal, but I feel good about the recommendation of getting out of there, and the new funds are outperforming the old funds, so that's good. One thing I do want to talk about, we talked about this the last couple quarters, the long-term numbers for River Place are struggling, right? They're underperforming their index, the S&P 500, going back to 2009. We talked about this last quarter, when I think about an active manager and paying them an active management fee to either beat their index, or if they're going to be below the index or in line with the index, they should do it with less risk. And River Place hasn't done that. And I think the argument has been that because they're 50% of the fund, they have always been the piggy bank, and it's been hard for them, even though our numbers account for cash flows. That's the institutional standard. But taking that argument just at face value and saying, okay, I agree with that, and I am a little skeptical of that, but if I just kept it at face value and said, okay, the reason why you're underperforming is because of these cash flows, there's a simple solution to that. We create a new piggy bank. So we take money from River Place and put it into a Vanguard or a Fidelity 500 index fund, where you're paying, instead of paying 0.8% to River Place, you pay 0.015%. And then we have this piggy bank that when we have cash flow needs, we don't have to bother Peter. Him and his team can do their thing. We don't have to ask them for money, and we can just draw upon the index fund for cash needs going forward. I think that is a good solution and one that I would recommend.
How much are you proposing?
So my thought is that we would do, so right now we're paying out about $600,000 a year. So roughly, let's say $500,000. Let's put 3 years worth in an index fund. That would be $1.5 million. And that equates to about 15% of your total fund. So River Place would come down from 50% of the total fund to 35%. We would get a low-cost index fund in there. We don't have to bother Peter anymore. We can just use that for our cash flow needs going forward, and then 3 years from now, we could top it off or just rebalance as we see fit. Maybe the value funds start to outperform, and we take the money and from the value funds, but we can determine that. But there's no magic formula about that. It's just kind of a rough math. Let's get 3 years worth of our cash needs and put it into the index fund.
Peter, did you hear that?
Yeah, I did. I question why it has to be 3 years. That seems to be an awful lot. I think it's kind of a way to get money out of us and put it into an index fund is the bottom line. We're never gonna, we're not dealing with $50 million, $100 million account here. We're gonna always be kind of either a little behind or a little ahead. Over the years, we've done a good job. I know he's picking on 10 years here, and I addressed that last time. I think we hit a low point. We hit a year when value, the shift was so dramatic from growth to value, and we underperformed because of that, or that was one big reason that we underperformed. This year, we're doing well. And that's been the way that this account has gone over the years. And you've even noted, David, that we're never, you know, it's either we're way ahead or we're a bit behind. I think $1.5 million is a lot just to have as a slush fund.
Again, when I look at it, I look at it as just as a percentage of the total fund, right?
Sure.
They're 50% now, they would still be the largest manager that you have at 35%. And then we would have
Now you have
35% in River Place, 25% in
I
the
don't
Value
think you
Fund.
need to change it. All of those funds, if they're index fund, that's what you're measuring, they always gonna be on the money, because that's what they got it down.
Well, plus or minus their operating expenses.
Right, but I mean, when you go to stack them up, if you've got a Vanguard S&P 500 fund, it's gonna vary every day, they're gonna change to keep up with whatever happens to that fund.
Well, you are eliminating the possibility of over exceeding the return. Because you just gotta end up with.
Right, so the downside of going from an active manager to an index fund is you give up the upside, right? So you,
Potential upside.
potential upside. Yeah,
Daniel,
I look at it like Peter. As far as if we were gonna do that, why would we pull a 3-year star? Why not do a smaller amount and see how the puzzle pieces fall into place and
yeah,
see how it goes instead of pulling a $1.5 million
yeah,
account.
and then
Or
that's,
making a 1.5 million.
yeah, and like I said, there's no magic formula about the 3 years, it was kind
we
of,
got 100,000.
arbitrary.
I'm gonna call it the dead checking account. Peter, did you reinvest all that cash? I think you said so.
Yeah,
But you
pretty
got a
much.
bunch of cash.
Yeah, pretty much. Because I get penalized for holding too much cash. Now, we make some changes from time to time, and we did toward the end of the year. And we
That's
were
a good
holding
time
a
to
bit
do
more
it,
cash.
actually, so.
so do you wanna split the difference and do, so would effectively be 18 months of cash, which would be 750,000?
Yeah, the one that ain't made nothing is the bond fund, and if my reading is right, we're still less than 2%.
For the last 10 years, yeah, and they've, your fund has done well relative to the market, right, it's outperformed. But yeah,
Well,
now, we only have 15% in bonds, you really want some bonds out, you know, and remember when,
Yeah, but ain't bonds a little better than that right now?
oh, yeah, yeah,
Okay, but if you got a portfolio, you had them with a, call it a, even a floating number, like a 4-year duration. You still got 3 years to go before you start right going up, so those problems are priced down. We'll have an opportunity to reprice up, so.
Do we have enough cash right now to make it to the next meeting?
Uh,
I just feel like
I don't know.
I just feel like maybe Adam should be here for this conversation also, being here.
Sure, I appreciate
Jump
that.
out.
yeah, so particularly if we get, because we have about 150,000 in, I think, that first federal account, and I don't know what the exact number is.
I think so.
But as of 12/31, right, we had 261,000 in First Federal or sitting in cash at Fifth Third, which covers our next 3 months. So I think the answer is yes. Now, we paid out January 2nd and February 2nd. We paid out probably about 100,000 of that, but it still gets us to,
Some of these bills, I will point out, because of the administration transition, they didn't get paid. So you're gonna have some admin costs. It's gonna be a little bigger this quarter than it has been, so.
I got you.
So,
I'm just saying if we had enough to float it until next meeting, that way Adam could be here with this.
No, I think that makes sense.
that makes sense. I'm okay with that.
So, I mean, but if the bills, because I do know, you know, we're basically paying out just in benefits, 50,000 a month. So from 12/31, we paid out January, we paid out February, March is coming. So we paid out 100,000. If you're saying we have more between now and the next meeting, we probably should raise 100,000 or so. And we can split that between stocks and bonds.
Yeah, and I don't have a clue when the city plans on making their payments, so I typically do that right
I don't think they do.
I think they pay at the last moment before somebody says something to them.
They don't have a guideline they're supposed to go by.
They do, they don't. Why don't we raise 150 just because we gotta pay the bills?
Okay,
And you'll do the paperwork on that, and then we'll turn around and the next meeting, we'll try to, when Adam's here, come up with a scheme to, you know, plan, a model, whatever you wanna call it, to identify how we're gonna handle it. I do think, what's driving this actually more than investment returns is, okay, we're spending $50,000 of, you know, we put quite a bit of money every month on benefits compared to what's coming in. We're kind of in a net liquidation mode almost. And because we're pretty close to 100% actuarial funded, so we're always gonna have to draw down to be able to pay the bills. It's not gonna ever earn, I think, enough money. Not to.
Okay. So that is not, we don't have enough Ponzi.
That's right. We need to hire some more firemen.
and you know, administratively, right now, when we have to raise cash, now that we have a couple mutual funds, it's easier, because I just say, fifth or thought, sell this, and the next day we get the cash. But for Peter, it's a process, right? They have to go in and say, what stocks do we need to, or if they don't have the cash available, they need to go into the market, figure out when to sell, and then that takes you know, it's usually a trade day +2, I believe. It's a little bit longer, so that's another factor about, you know,
So
liquidity factor.
The SEC, they're changing that.
Oh, to go to trade day +1? Yeah, there's been rumors of that, I didn't see that announcement yet. But, so I think that's prudent, and I think, you know, having Adam's voice would be welcome about where we end up going.
And then whatever we do, once we come up with a cash budget, maybe Brad can help us, or administrators, kind of do a little spreadsheet. So that we can say, well, this is how much cash we're gonna need, you know, do it, you know what we're doing versus kind of just, you know, actual bills that come in, so.
Yeah, so I know what the distribution is. I would probably need to work with Michelle to figure out what the other bill is like. So what's the annual actuarial bill? What's, you know, I know what my bill is. I'm not sure what their bill is, but you know, and whatever.
Board training and.
Yeah, and all that stuff. We can incorporate that all plus the benefit payment and say, here's our yearly nut, and then
I think
how.
the city comes up with a budget. You might ask the city as well.
Yeah.
But then we know what our number is, then we know how much we liquidate, because it is, I think that's really the problem here, is that we're in a liquidation mode. We're always gonna be dipping into it. Especially when the city's contribution, the way to look at it is what, 50,000 a month, is that roughly what it is, I think, for benefits?
That's what the net number is between what is coming in from contributions from active members or the city contribution, and then what we're paying now.
$600,000 a year, and we get like $65,000 from the state or something like that. So otherwise, you gotta have, you know, earnings or it's gotta come somewhere. That's what.
So
Contribution.
we're paying that 50 grand more than they're putting in.
Yeah. We kind of turned the heat here in the past few years.
Well, we lost, what happened, we lost a bunch of
Well, it's the county and dirt thing.
county people.
Well, we're back up to 8, and they were at 10.
Huh?
They were at 10 per day. Whenever the county started, we went to 6. And in the last 2 or 3 years, they've got it back up to 8
They were.
per day. So there's 24 total, actually 26 total that contribute to the fund. Where there used to be 32.
The new fire station, got hire anybody or no?
Scratch the budget, find ways to make it happen, but they're, I think, they'll,
You gotta get an electrical panel first.
yeah, once here,
Is there?
finally it's here,
Yeah, they gonna build a new fire station?
it's already built. It's off of Hall of Fame Drive, by
Okay.
Old Skate Rink.
It's been sitting there idle for like
Anybody in it?
Oh, yeah, we've been waiting on
electrical
an
panel.
electrical panel.
Had to come from China, be custom made, you know, something like that.
So I got a firehouse in Swanee, saying a fire truck.
Yeah, well, I figured our panel was in that direction.
Problem.
But anyway,
It's like what?
I think we have a plan for next quarter, but I will need a motion to approve the cash rate. So what my recommendation would, we just go by the asset allocation now. So $75,000 from River Place, $25,000 from Dodge and Cox DOD GX, $25,000 from Vanguard Equity Income, VEIRX, and $25,000 from Integrity Fixed Income.
You guys can make a motion.
I'll make a motion that we follow Brad's
Recommendation.
financial.
Just get this quarter.
Yes, sir. Motion is that all in favor say aye. Good.
All right, that's all I had. Appreciate it.
Okay,
Thank you.
Other business, designation of a records management liaison officer. I think the city was doing that prior, but apparently not now, so.
They're doing what?
So, hang on just a second, I'm trying to get these motions down. And that was,
Okay.
3, 2.
We're normally not this busy.
You sure? Why don't you introduce me?
Okay, yeah, first of all, I know I was gonna be your plan administrator for the, this, plan, but I actually am gonna be retiring April 1st. Yay!
Congratulations.
Thank you. And so Michelle is gonna be taking over the plan. She actually lives in a town named Muley, which is really actually closer to Tallahassee. Michelle's been in the field, how many years is Michelle? She was 4 years at, she was in 4 years at the state of Florida at FRS.
Mhm.
And then she came over to Tallahassee, was in Tallahassee for 13 years.
Where Kim trained me.
Yeah, that's when I met Michelle. And then she moved to DC along with her husband. Her husband was in the military. She was in DC for 4 years.
Mhm.
And then from there, she came back to Florida with her husband and moving around and was working in a defined contribution plan for a couple of years. And then we hired her on with Foster and Foster, and she will be here with us for 5 years at the end of this year.
Who's
So-
working for the DB plan?
It was a company called, oh my God, I can't remember, something benefits. It was only for a few months,
Yeah.
yeah, and they provided 401ks for teacher plans in South Florida, yeah.
And I
for
was
the
able to
teachers.
rescue her from that group.
Yeah, I did enjoy defined contribution. I really enjoyed defined benefit plans for police and fire, general as well. It's just what I've always done. When I was in DC, I worked for the Transit Authority and handled their police pension plan.
DC plans have a whole lot more moving parts.
They
Oh,
do,
yeah.
they do.
In Tallahassee, we had both a DB and a DC. Actually, Tallahassee has their own 401k that they allow the.
But I just feel like DB plans are kind of going away and I have a passion for them. I think that, you know, especially public service employees really deserve a
Service
DB
sector, they
plan.
gotta stay. Everywhere else, the tax and accounting for them is too difficult and nobody wants to do it.
Exactly, yeah.
I mean, have anybody still has a DB plan now? That's not maybe a rich healthcare too,
Yeah. I just, you know,
By the wayside.
yeah, just too,
rooting for the underdog, I guess,
yeah.
DB plans.
So leaving you guys in good hands, she's very diverse in her
So
experience,
she's
so.
gonna be the records management liaison officer?
Yeah, actually, she actually came over with me when we went through all the files together, because she's actually our operations manager. So she went through all that piece, she oversees all the records. So we did pick up all the records and had, I think most of them have been scanned in by now.
Mm-hmm.
Again, and.
We don't have a whole lot, we don't do a whole lot, so.
Yeah, but we've hit cities before where they did nothing on the records. Recently at Crestview, we went over there, they must have 70 boxes for us.
Oh my goodness.
And they never managed it at all, so we're kind of going through that piece and we're learning now that when we come to a city that doesn't have their management up to date on the records, that we're trying to, because it's gonna take us a moment to go through all those
Hopefully we
files.
won't do that.
But you got, no,
No.
you guys were wonderful, and the ladies, I don't remember
Angie
who,
Taylor and.
they helped us, they were wonderful, they were
Yes.
so nice, they gave us, you know, a big room to spread out in and get everything taken care of, but basically the records management liaison officer, when you designate Foster and Foster, me, I'll be the official custodian of your records, so any public records requests, anything like that, and we do follow the state, the GSL one schedule for records retention. Anytime we're gonna shred something, I'll come to you and I'll have a list of every document we wanna shred. You guys will look at it and approve it before anything gets shredded, otherwise it'll be in storage.
I
So,
got it.
Yeah.
And, for any of our local, people that want to have a record request, they go to you and you
Correct.
handle producing it or whatever.
That's right.
Okay.
Yeah.
All right.
And we do it just like the city will, respond within 5 business days, the whole thing, we go by the same process.
And you gotta let the city custodian know, so when she gets, because I think initially everybody goes to her,
Exactly, yep.
so.
Yeah, yeah.
I'm fine with that. I don't know if we have to make a motion on that, but that's.
Yeah, we do, if you don't mind.
Okay.
What now?
We gotta make a motion to designate them the records custodian.
I'll make the motion.
Because I sure don't want to do that. All right,
I'll say.
all right, everybody in favor say aye. That's it.
Thank
We don't
you.
have any old business, the consent agenda we already talked about.
No, the consent agenda, we'll go ahead and, that's for the invoices that need to be approved, and we already do that.
We just need a motion on that. I think you guys looked at it. So the consent agenda, just to let you all know, moving forward, it's gonna include a summary of payments that has all the bills that we paid between, meetings, and then it'll also have, any benefit payments, so if we set up any retirees, if we made a lump sum distribution, refund contributions, all of that will be listed out for you. And when we send you the agenda packet, you just take a look at that and make sure everything's in order. If you don't have any questions or anything, when we come to the meeting, I'll ask David to make a motion, and you guys are just basically ratifying, those payments that were already made.
That's fine.
Yeah, so all these invoices we need to pay since we
Yeah, this
haven't
is
been
the
approved to do it,
transition
so
back then.
typically we'll have them already paid before we show up to a meeting.
Right, that's fine.
Yeah.
So I'll move.
Does the board need to make a motion to formally authorize you to pay these things, or is that already done?
That's what they're about to do.
Well, they're gonna do that now, but moving forward, we can pay bills between meetings without getting their prior approval, and then,
We did that one time, we made, if we owed the bill, they're gotta pay it, then we do this every time.
right.
Mhm.
Yeah, but that's what I'm saying. She's just gonna give you a list and say it's okay, I think is what it is.
And then you guys are gonna review it and make, and ratify it at the meeting, saying, yep, we have looked at this, we agree with it, it's already done, but you're just gonna ratify it.
Right, now, I think in this case, they're asking us to approve it because these bills were before they.
So Peter.
Peter, take care.
Thank you.
All right. I'm fine with that. Let's make a motion to pay them.
Oh, yeah.
Pay the bills. Let's go. Oh, we gotta not pay our bills, so.
Yeah.
Right.
Yeah.
And just this first time, Al, just so you know, the only reason that we couldn't pay them is we didn't have authorization yet to the bank. So if we had sent these bills to the bank, they would have said, I don't know who you are, I'm not paying
Oh, you're
these.
talking about Fifth Third.
Fifth Third, right.
Okay.
So now we've, notified them that we're the new administrators, so now
Okay,
moving
I got
forward,
you.
they'll let us pay stuff, yeah.
All right. All in favor, say aye. Okay, we're done.
Thank you.
Jean, we've been talking about staff reports and discussions here. Kim, is there anything else to talk about? Annual report, not gonna work on that.
Yes, we're working on the annual report right now. We just didn't get a motion on that at the last meeting. You guys approved for us to take over. That's an additional thing that we do. It's $3,200 for us to complete that for you. So we just need to go ahead and get a motion today that you'd like us to take on doing the annual report.
What kind of report?
That's that.
The state annual report. That gets
Annual
our,
report to the state. In the
that's
past-
how we get our state
Represented in
monies.
the state.
Yeah, it's a required thing.
Mhm.
In the past, we've used, Ricky Parker did it for the longest time, and that's about what he was charging. And, then after Ricky Parker kind of left, not literally, yeah, Donna Duncan did it, when she was at the city, now Donna's gone, the city doesn't want to do anything with that, so we're stuck. All right,
Let's stop shop.
let's stop shop on, never mind. Made the motion and Al seconded, all in favor, say aye.
Okay, just to let you know,
By the way,
we are
let's-
gathering data
Well,
right
what are
now.
we telling the state is,
Oh, it's a book, it's how much, it's all your investments, all
Oh,
the
it's
people.
huge,
It's a bunch of public records
from
stuff.
beginning to end.
It's
But we have
A
to do this
list
to
of
get
all
our
your
state money.
retirees, a list of all your actives,
people's
What else is
election,
included
what
in
their
there?
beneficiaries
your
are.
beneficiaries,
I'll get the some of it's in your pocket.
when your budget was, prepared, when your expenses were prepared.
It's a bunch of detail that's probably overkill.
And they're even wanted us to jump through more this
But we do the
year.
exact
So
same
what
thing.
they add to it this year?
Oh, absolutely.
We have to now do the declaration of interest. When we declare the interest, they're wanting documentation, and we send that to the state. That was the same. They're now asking for the contact of the city, typically they didn't ask for that before.
Now they wanna know when the check was received
Oh, yeah.
and when it was deposited.
The state, now they wanna know when that state,
Well,
because
they
they,
always had a receipt you had to sign.
yes,
I mean, the mayor one time.
That's what I don't understand, we send that back to them, and now they want us to,
well, it'd be one
Like,
thing,
send
But
it back
they
to them,
don't
it
want
doesn't
to pay
make
for
any
somebody to put it in a spreadsheet, but
well, the one thing is they do need to know when it was deposited. I mean,
Right.
I understand the receipt part because I know when they sent it out, but they
Yeah, I
need
do
to
know.
know because it's 5 days from the time you receive it, you have to have it into the pension fund.
well, we went, we didn't do that one time because they sent it to the mayor, it says addressed to the mayor. He was on vacation, like, out of the country and sat on his desk for like 6 weeks, but, you know.
I
It
know,
happens.
I know there's a little grace period there, but I do know with one of my plans, it
They
did
got
not
kind of
deposit in time. They did
conversation.
charge they make you pay interest, the city has to pay interest if it doesn't get into the plan in time. And it did happen on one of my plans, where they came back
They can
and
make
said
a
they
statement.
owe another $2,000 into the plan because it didn't make it there in time.
Oh, that's-
So, yeah, so
That's
that's
a
a new
little
piece.
But I did one thing, Mike, he did have a good comment about, I did this for the city a number of years ago. There are companies that are out there that will look into the designation of getting, the tax part, the funds that, do you guys know of anybody else that's doing any audits?
they call them a key holder. So Steve Barden up at the state, he's with the, local retirement plans like you guys. And he explained to me that every city has a municipality has what they call a key holder. And it's their responsibility to make sure that all of the real estate that's supposed to be included is included.
Well,
But I
I know,
asked him, I said, well, how do we know who the key holder is? He goes, oh, we don't keep track of that.
I know with Lake City what happens, there's a
So,
statewide database that somebody maintains.
right,
And the insurance companies all have set up a system to ping off of it. It says, okay, Al's put in here, put Al's address in. And they ping off of it, it says, if it's in a municipality or not.
right.
By the way, the insurance companies don't have an incentive to get it right because the premium is the same. I
They don't
mean,
care.
They don't care. In other words, they're not really adding the 1.5% to your fee. All that is designating an existing one. In other words, they say you're not in the city, it goes to the state and they keep it. If they if you're a city, then it's.
But it goes to the state, then the state allocates it, right?
Correct.
Correct. But what I'm saying is the insurance company, they don't care because they're not like, they're not paying more or less. They're just allocating the existing money they're sending to the state.
They don't care that it's accurate, that it's actually a Lake City
Yeah.
zip code, right? They have to pay the same amount.
So they devote zero resources to keep.
Do they do
there.
it for Columbia County?
Columbia County doesn't get it, they go to the state. And what happens is, especially in Lake City where unless
No, what
you're,
is that?
The tornado.
Is a tornado coming?
I hope not, in this building we're dead.
You can hear
Did you hear that?
It's probably that
The
fish net
wind.
that's over the building.
it.
Okay, so the problem we had in the past is the city limits is so screwy.
Yeah, so unless you live here or know where it's at, nobody else can figure it
You
out.
go out 90, and there's
It's
you
like-
go out 90, and you think this, well, no, that little square right there ain't in the city.
I know,
You
and,
can get annexed when it went by.
and the state and the city spent a lot of money about 10 years ago when they put telecommunications tax in. They come up with a database, it's all the same database whether you're in or not out. And I don't know if anybody's looked at it since then, and they do deal with annexations. But at the end of the day, it's it's a lot of work for not a lot of money. You know, you spend $30,000 having somebody do a review, and not bat an eye, and increase your take $2,000.
Or maybe decrease it.
How does the state figure out how much this is?
That is the black box.
Yeah, that's
I've
the
asked
black
that
box.
lady over there, what was that lady's name before she retired? She's running for-
Patricia?
Huh?
Patricia Shoemaker?
There you go. She basically told me it's none of my business.
Wait a minute.
Wait a
Yeah,
minute.
they had a process, they did it, you know,
Yeah, she used to be my boss.
yearly, but it was
She's a
kind of,
nice lady.
she
she
was
told me
not
a lot of
really
things weren't my
forthcoming.
business
She
either.
basically said so many words.
Don't worry about it.
But yeah,
Lady got something.
yeah.
Hey, I thought they had that lot of money from the insurance company, and they just ended up sending it out.
Well, it's based on the designation partially, and then the state hits you with layered fees for collecting it and managing it. And that's where the black box starts, how they allocate that. Then they have, certain communities have over collections and it gets complicated really fast.
And then there's a fire educational supplement that sometimes you get and sometimes you don't, and nobody can explain why.
Yeah,
Sometimes you get it and sometimes you don't, so.
but it might be worth, if you know who to talk to in Tallahassee, maybe, it might be worth writing a letter and say, hey, this is going down, can you give us some kind of color as to why it's going down?
Well, they have that conference every year, Brad, why don't they have a seminar on how they calculate?
I don't think anybody knows.
They don't want anyone to know exactly. Why would they have someone poking holes into, because right now, like
I-
you're saying,
I
right,
really want
the
to
county
create a
money
fire
goes
school.
back to the state, just the municipalities get it.
Our local state representatives always want to do something to help us. You know, he gets your money, I could probably rattle their cage pretty rattly,
Put them on it.
you know, put him on it, and then, they tell him they can't figure it out, that'd probably be the last time they say that. But, I don't know if I would be responsible for that.
Oh, goodness.
But it is true. Lake City, though, out toward the interstate, we're adding hotels out there, and they're inside the city limits. Those are big ticket fire insurance.
Yeah, they are.
And if somebody puts no, because they don't realize,
Costs about $140,000
We don't
to
think
keep
commercial
that.
is residential.
oh, no, and you gotta insure it. The problem is, does anybody like to know, I don't think there's a way to find out directly, Brad, do you know this? Is there a way to find out direct, like, okay, if you've got a multi-million-dollar building sitting here, I don't know of a way that you can find out if their insurance company said they were in the city or out of the city.
Yeah, I don't know how that whole
I don't know how
thing
you,
is. Yeah,
because
I
my
know that
understanding,
they tried to
The
match up
question
the
is, you have a physical fire cover. When you insurance, they don't care whether it's city or county.
yeah, but I don't think we have the right to go to them and ask for it. And like State Farm, I don't think sends a list, I think State Farm just says, here's the
But I've had
money.
other plans that'll break out like the map, right? And then they'll go, and then they'll figure out, like, this is down in South Florida. City Homestead, their fire plan was trying to figure this out, because they thought they, same kind of deal, like, we haven't gotten increased money, there's all kinds of development going on in Homestead. And ends up like Miami-Dade is claiming this, but also Homestead is like a big kind of like. just
Hey Brad, do you
mess.
know if commercial properties included or is it just residential?
I don't know.
Yeah, nobody can answer that for me either. Probably just residential, I would think. I don't know.
I have to look, yeah, you're gonna put out a commercial fire.
Fire, it's a commercial building.
Sorry, this isn't a commercial building, can't help you.
6 stories.
Or-
No limit, 6 stories.
So I was told that one time, but then I guess some stuff has come up to where nobody can really find where that started. They can't, I don't think they can produce an ordinance on it or anything else.
No, actually, I'm listening. Y'all got a ladder now,
For the moment, we get everything in town.
so you go to 6 stories.
This might be a 12-story building, it'd be a problem.
I heard there was a rumor before Randy passed that somebody was trying to do a 10.
Can you just like screw two hoses together and?
So we build.
It's a project, I don't know, I can figure it out.
All right, anybody else got anything going left from the clause?
So,
Brad, thank you very much for everything you did.
All right, nobody leave, I need signatures
for what?
on everything.
Oh, yeah, by the way, guys, this annual senior report for supervisor elections time, don't forget about it.
It said it wasn't yet.
No, don't, it should, sometimes they do, sometimes they're not really
Tommy
good.
will.
Could you give me all your contact info, and if you don't want to put your home
Would it be
address,
safe to
put
say
a work address or
that
PO
as
box,
losers,
whatever, and that's my call.
He's the only one.
He's the only one in there, yeah.
Because I'm sure he hasn't seen
Are y'all adjourned?
Could you put,
Oh, yes, we're adjourned.
your,
Sorry about that.
whatever you do.
contact
Good job
info,
over
if you
there.
don't want to put your home address, don't
Is this your